Hello and welcome. In this tutorial we're going to look at intrinsic value. Now this is the actual value of a company or an asset based on an underlying perception of its true value, including all aspects of the business in terms of both tangible and intangible factors. The value may or may not be the same as the current market value. Value investors use a variety of analytical techniques in order to estimate the intrinsic value of securities in hopes of finding investments where the true value of the investment exceeds its current value. Value investors that follow fundamental analysis look at both qualitative business model, governance, target market factors, etc., and quantitative, that is, ratios, financial statement analysis, etc., aspects of a business to see if the business is currently out of favor with the market and is really worth much more than its current value. There is a significant difference between intrinsic value and market value. Intrinsic value is an estimate of the actual true value of a company. Market value is the value of a company as reflected by the company's stock price. Therefore, market value may be significantly higher or lower than intrinsic value. Right. So there we have a graphical representation of the situation between intrinsic value and market value. And according to this graph, the red line indicates this red line we have here indicates the intrinsic value of a company, which you can actually call the estimate of the actual value of the company. That's the estimate of the actual value of the company, the intrinsic value. And then the market price, that's the price of the company as shown on the stock exchange. And we said this market value is determined using the forces of demand and supply and factors in investors' fears, assumptions, and asset portfolio adjustments factors and stuff like that. So the price of the market might not reflect the actual value of the company. So when the market value is much higher than the intrinsic value of the company, we say the asset is overvalued. When the market value is much lower than the intrinsic value of the asset, we say the asset is undervalued or underpriced. So this, when the market is underpriced, is the best time for you to buy your asset. If you buy an asset which is undervalued, you have a better chance of making money, simply because assets have a tendency of moving towards their intrinsic value, which is the true value over time. Right. So this could have been caused by certain market fears, and the price would have dipped, or maybe another investor who was just offloading part of their holding in the company, and therefore there was excess supply of the shares of the company and the price went down. So when you know the intrinsic value of a company, you can be able to tell whether the company is undervalued or overvalued. Therefore, you have an opportunity of buying underpriced shares and make money in the market. The same goes for overpriced. This is not the best time for you to buy in a market, because overpriced securities are prone to correct, and when they correct, they go lower. And when the price goes lower, if you're not selling, then it means you're losing money. If you're holding these shares of this company, the price is declining and then you'll be losing money. But if you're selling these shares, then you stand a chance of making money. So that's the situation, that's the difference between market price and intrinsic value, you need to understand that you have to know these prices for you to be able to make money in investing. You do not make money by buying assets that you do not know their actual value, which is the intrinsic value. You need to know the intrinsic value first before you buy an asset. And all the models that we're going to look at in this course will help you in identifying the intrinsic value of a company, which can then help you to be able to hold assets that are at the right price or lower.